Well, in this video, we're going to talk about investor protection, very important area. So we work very hard to build up our financial assets. Obviously, it'd be very disheartening if we lost our capital because the financial institution or the government that we were dealing with went bankrupt, and then we've lost our capital. So over the years, different insurance schemes or investor protection mechanisms have developed. And so I'll cover off the basic approach you want to take to fixed income investing to protect yourself. So the first thing that we need to revisit again is that we're making a loan. So whenever you are extending capital to a government, financial institution, a bank or trust company or credit union, you are loaning them capital. And when you extend that loan to them, that loan now shows up on their balance sheet. And on that balance sheet, the financial institution is going to have assets, and they have, of course, liabilities. Now, your loan shows up as a liability to the financial institution or their corporation or whatever entity you've loaned money to. And that can be problematic because if this financial institution goes under, you're one of many creditors in line looking to receive your money. Depending on the institution, in the eventuality of this happening, you may not get any of your money back, or you may get cents on the dollar. Now clearly that's not a situation that any of us want to be in. So the first thing that I'll talk about is banks, trust companies, credit unions. I'll focus in on the banks and trust companies here. Many years ago, an insurance protection called Canada Deposit Insurance Corporation, CDIC, was established for investors. And it's an insurance pool that all financial institutions pay into to provide capital in the event that a financial institution becomes insolvent or goes bankrupt. It's there to protect investors so they get their money back. And so with CDIC, you have $100,000 of protection for GICs. And you can increase your protection in different ways. So if I walk into a bank, I could have $100,000 of protection in my name. I could have $100,000 of protection if I'm married in a joint account. I could have another $100,000 in my RSP account. I could have another $100,000 in my RIF account. Okay, so I can really increase those limits. My spouse could have a RSP up to $100,000, RIF up to $100,000. So for many families, that probably is sufficient in terms of covering. The other thing is that many institutions will have the ability to double up on all these coverages because, I'll give you an example. If I walk into the Royal Bank, I could get Royal Bank deposit insurance through CDIC, and then they can offer also deposit insurance through Royal Trust. So many of the institutions will have sister or affiliated companies that have their own CDIC limits. And so when we look at the insurance industry, we look at the credit unions as an example, they as well have insurance or investor protection funds to protect you. So it's important we be aware of that. One of the benefits of dealing with GIC brokers, investment brokers, financial planners is that they can broker GICs for you. And so you can have one account, and out of that one account they can buy in GIC contracts with many different financial institutions under the one account. So I could have a GIC up to $100,000 with CIBC, one with the Royal Bank, one with Scotiabank, one with National Bank, and I could pretty much have almost unlimited CDIC coverage. So through that one account I can just keep adding and adding and adding over time. The other benefit of that is that this is nice, but let's say I've got a really great interest rate on my GIC. The CDIC is not going to honor that interest rate. They'll honor repayment of your capital, but if I've got some great interest rates and all of a sudden my institution goes under and I've consolidated most of my money with them, I could lose that rate, which would not be a great situation. So one of the benefits of diversifying through an insurance broker or an investment dealer is you can diversify that way. So that's for traditional loanership investing, GICs, term deposits, savings accounts as an example, in the context of your traditional banks or trust companies. Like I said, the credit unions have their own investor protection as well. Now, Let's take a look at investor protection as it relates to the traditional bond market. So traditional bond market, we've got federal bonds. Let's start there. Well, with federal government bonds, they have the highest credit quality, and one of the reasons for that is there's two characteristics that the federal government has. One is they have powers of taxation. So that's an important power in terms of guaranteeing, or at least potentially guaranteeing, their ability to honor that bond when it matures. They have powers of taxation, and they print money. Now, if a government got into a lot of trouble and they were trying to print their way out of that problem, I mean, that causes issues around currency valuations and what is my money really worth when that bond matures in Canadian dollars or US dollars or whatever. So we hope that the government will manage their fiscal house properly, but to the extent that they have taxation powers and print money, that's a pretty big guarantee. So that's one level. We have provincial bonds. So the provinces, they don't print money, but obviously they have powers of taxation. The next level of bonds that we'll talk about would be corporate bonds. Now, corporate bonds is unsecured debt, so again, you don't have specific assets pledged against that bond. It's a general pledge against basically the balance sheet or the net worth statement of the company, and its cash flow or earnings. So whenever someone buys a corporate bond, they're basically saying, well, I'm looking at its earnings, I'm looking at its cash flow, I'm looking at its debt levels and its assets, I'm looking at how dominant it is in the market that it works in. And so if I go with a very large company, like a large mainline insurance company, life insurance company, or bank, or maybe a large energy company, there's all kinds of companies out there that are so dominant that when you buy their bonds, their debt rating would be the same as a provincial government. And so the thing to keep in mind, though, at the end of the day is it's not secured. Corporate debentures mean that if the company goes under and they don't have enough assets to cover off bondholders, you may be left holding the bag. You may not get all your money back, or may not get any of it back, depending on the business that you deal with. And you can see, bond ratings. The highest quality, like I said, would be AAA, and you can get down to C or double C ratings, which are sometimes referred to as junk bond rated. And that's really the domain of institutional investors. So there are a lot of institutional investors who will buy lower credit quality bonds and do it successfully in terms of building yield and growth for investors over time. But that's a very, very specialized area. For the average investor buying individual bonds, they'll tend to stay in these areas. And I think that if you stay in these areas and focus on good credit quality and good financial strength of the businesses or governments you're dealing with, you're not likely to have problems or issues. Okay, so just to summarize, what are your protections? Well, keep in mind, you're giving a loan. It's now on the balance sheet. You are a liability to that financial institution, government, or corporation, and so you want protection. With the banks and trust companies, you have CDIC as an example. We cover that off. And, of course, with governments, they have powers of taxation, and with the federal government, they print our money. And with corporations, it really is an analysis of the soundness and strength of that corporation, the ability to repay debt in the event that that bond comes due down the road. And so you take on a little more risk with the corporation. This is ironclad. Why do investors look at these areas? Again, just to enhance yield. And certainly over the last little while, yield's been tough to find. We're at a historic low in interest rates. And so you see investors beginning to drift down into these categories as a way of trying to get additional yield.